Well, this morning's JOLTS release is the first of a slew of economic data prints in the coming days. Our next guest warning that those releases could potentially be catalyst here for market volatility. Joining us now, we want to bring in Jeff Jacobson, head of derivative strategy at 22V Research. He joins us now. Jeff, it's great to have you here. So you say investors should brace for more volatility ahead, especially off the back of some of the economic data prints that we have up on the screen right now. Talk to me about the why factor. What's driving that prediction?
Yes, absolutely. So, we've seen volatility pick up in the market over the last, call it 11 trading days. We've seen realized moves in the market almost around, let's call it 0.75% on a daily, on half the time on a daily basis. So what that's doing is pushing up the realized volatility. At the same time, we've seen the VIX come down from the December highs when we hit the high on the last FOMC report. So you're getting a scenario set up here where implied vol, or the cost of buying protection, has come in, yet at the same time we've seen realized volatility move up. Now this is coming at a time ahead of, to your point, all the key economic data that we will be getting over the next few weeks, whether it's payrolls, the inflation data on CPI. We have another Fed meeting at the end of the month. So, we have plenty of opportunity, if that's the right word, to where we could see heightened volatility. And certainly, if we get the moves in the bond market that would go against, higher yields, which would go against favoring stocks here, there could be a setup where we could see, a decent pullback after this brief rally that we've had over the last few days.
So obviously a ton of economic data ahead to watch, but what do you think are the key catalysts for volatility moving forward from that slew of economic data?
I think it's going to, again, come back to the bond market. We had the 10-year yield up to about 4.65. The highs we hit in the last year and change were 4.7 and 5%. We're at 4.65 now. When we've hit those levels previously, we saw a decided pullback in stocks. That hasn't really been the case here for the S&P. We've seen other parts of the market, obviously the more interest rate sensitive parts, small caps, come in, and the large caps, the S&P, have held up very well. My guess would be that, if we get a move back north of 4.7 or higher on the 10-year, that may be the trigger where we could see that volatility that I was speaking of.
And we just have that, we have it up on your screen just in terms of the pullback that we do see in equities as we do see yields hit those levels here. Jeff, as we talk about then what investors should do at this point, we have a real risk here. We could see yields very soon eclipse that level. What is that top trade then to protect your portfolio?
Yeah, like I said, it's a great setup in the sense that the cost of insurance has come down, like I said, from the December highs, at the same time where realized volatility is coming up. That's a great opportunity to buy, just straight out SPY puts, in my opinion. You can buy, the trade I suggested in my note was buying the February 7th SPY put, the 582.50 put. It's about 2% below where the market's trading now. And you have a month that will capture all the economic data I mentioned, the Fed meeting, earnings season for pretty much, most of the large cap names, the banks, the industrials. So I don't think you're going to see a real decrease in implied vol because A, realized vol has been moving up, like I said, and B, you have all these upcoming events and catalysts that could trigger, weakness, especially if we start to see yields move much higher. So, I like buying puts outright here, and if we do get a move lower, not only will you be able to monetize those puts, but it'll obviously act as a nice portfolio hedge for if you have large cap exposure, which most people do.
You mentioned that key Fed meeting coming up here, just crossing the wire. Traders are no longer fully pricing in a Fed cut before that July meeting. Jeff, how much volatility might that cause? And if we do see a lot of buying of volatility, does that indicate to you kind of a bearish swing in the market?
Yeah, I think that certainly, if you remember, we had, quite a large move in volatility and the market the last Fed meeting, specifically when Powell was speaking. I think you're going to start to see a relative bid to volatility again into that meeting, which is why I like kind of getting ahead of it here and owning vol. And certainly, I think, again, however the bond market will react to the meeting and the events leading up to it will probably dictate, how stocks do from here, especially the large caps that, again, have held up, very well in the face of rising yields.
All right, Jeff, we got to leave it there. Thanks so much for joining us.
Thank you.